On Wednesday, the Fed held a meeting that aimed to regulate the economy by controlling inflation. They concluded the meeting with an interest rate hike of 75 basis points, and this will have a huge impact on the economy and the housing market specifically. Fed Chairman Jerome Powell said that the central bank will not count on the lagged impacts of shelter costs and inflation metrics when determining its policy moves. "I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. It may take some time. Hope for the best, plan for the worst," he said. In its quest to bring down inflation running near its highest levels since the early 1980s, the central bank took its federal funds rate up to a range of 3% to 3.25%, the highest it has been since early 2008, following the third consecutive 0.75 percentage point move. Traders have been concerned that the Fed is remaining more hawkish for longer than some had anticipated. Projections from the meeting indicated that the Fed expects to raise rates by at least 1.25 percentage points in its two remaining meetings this year. Along with the massive rate increases, Fed officials signaled the intention of continuing to hike until the funds level hits a terminal rate, or the endpoint of 4.6% in 2023. That implies a quarter-point rate hike next year but no decreases. Since the beginning of interest hikes in March, home sales have decelerated. In fact, sales of previously owned homes declined for the seventh straight month in August, as rising mortgage rates priced out more potential buyers from the market. But the volume exceeded expectations. Contract closings fell 0.4% in August from July, to a seasonally adjusted annual rate of 4.8 million, according to the National Association of Realtors. The median estimate called for 4.69 million in a Bloomberg survey of economists. Sales fell 19.9% from 1 year ago. The figures underscore a slowing housing market as buyers face tougher conditions with mortgage rates rising, higher prices, and a low inventory of homes, a result of a slowdown in construction and homeowners reluctant to list for sale. Higher financing costs have dampened buyer purchasing power, and mortgage payments are 66% higher than the same week in 2021. According to Zillow Research, even buyers able to afford a house at current rates could feel frozen, waiting for mortgage rates to fall dramatically again as they did from the end of June to mid-July, when rates dropped 50 basis points in just 2 weeks. To understand the impact of the underperforming housing market on the economy, here is a fact. A new home sold put roughly $50,000 in the economy in terms of real estate agent commission, and other things like renovation and so on. With the decline in home sales, you can understand the impact. On a personal level, interest hikes affect credit card debt. Fed rate hikes affect your credit card's annual percentage rate, APR, which determines how much interest you pay for any outstanding debt not paid off by the end of the month. When the rate hikes began in early 2022, average APRs were close to 16%, and have since climbed to just over 18%. With the recent increase, the average credit card APR could reach closer to 19%, according to the financial services site Bankrate. In that case, for a credit card balance of $5,000 with an APR of 19%, you'd pay an additional $1,197 in interest costs compared to an APR of 16%, if you only made the minimum payment each month. On the mortgage side, if you have a fixed-rate mortgage, rising interest rates will have no impact on your loan. However, if you get a new mortgage or have a variable-rate mortgage, your monthly payments could increase. Mortgage rates tend to rise with rate hikes, but they are more directly influenced by the bond market. Since early 2022, mortgage rates have climbed from 3% to over 6%, increasing the monthly costs on a 30-year fixed-rate $400,000 mortgage with a 20% down payment by a whopping $569. The one silver lining is that today's widely anticipated rate increase might already be baked into current mortgage rates, meaning they might not climb much further based on Wednesday's announcement. Mortgage rate forecasts for the remainder of the year are a mixed bag, with many suggesting that rates will level off. The smart move in the period of crisis is to stack up cash to invest in the crashing markets, as we will see discounted home prices in 2023. Tell us in the comment how you think the interest hikes will affect you, and don't forget to subscribe for more housing market updates.